In my last video, I went through how in my IRA, I was able to 10x the S&P. But when we look at that, it's like, okay, that's great. When we're in the down market, of course, anything fixed rate is going to beat the S&P. So in this video, I'm going to do a comparison over longer time horizons of how a passive real estate portfolio still 2x the S&P. And again, this is not to brag or anything like that. It's just to be transparent and enable you to make better decisions with real data. So I'll start with the question that a friend asked me, which is, why would I take the risk of a fixed rate fund when the S&P averages around 12% year over year? And that's a great question. So I'm going to start by thinking about that a little bit and sharing some charts here, and then I'll transition over to the portfolio comparison. So what we're looking at here is the S&P 500 index. And like my friend said, like we can see, this looks pretty good, right? And from 2013, which is basically all the data that we have available to us at Fred St. Louis, all the way to 2023, the average return was 17.65%, right? So that's really good. You know, we might think to ourselves, this is a really good place to be. But so, I was thinking this is a little odd because our nation's GDP only increased by about 5.5% during the same time period. So that's what you're seeing here. From 2013 to 2023, it increased by about 5.5%. So that's weird. The S&P is supposed to reflect the United States market, yet the country's ability to produce in our gross domestic product increased by a third of the S&P. So why would that be? The reason, the answer to that is fiscal policy, and specifically quantitative easing and our federal funds rate. So if we take a look at the S&P, this is from NASDAQ, relative to inflation, it doesn't look quite as good, right? It sort of looks like we are relatively static at around 4K for the last 3 years. And why is that? Is because, inflation is going to trail massive quantitative easing, which we started in 2008. So continuing a bit more, I thought to myself, okay, well, what has the S&P looked like when we didn't have an aggressive QE policy? Unfortunately, Fred St. Louis doesn't have good data for that, but what we do have is the NASDAQ. So I started thinking, what would be a good time period to see how would the Fed respond after a correction like we just had, and maybe an environment with less QE. So the best period I could think of was 2003 to 2008 for the correction and before QE. So during that period, we were pretty much flat. The NASDAQ returned negative 2.45% ROI. So that's a 6-year period with negative gains. Not good, right? So I started thinking, well, where are we now, right? What is the Fed going to do now? So if we take a look at M2, which is effectively the amount of money we have, we can see that we printed a lot, right? I'm sure you've heard that in the news, right? I'm sure everyone has heard that. The important part here, though, is we are still significantly off of trend line, significantly off trend line. We can see we had relatively reliable growth for the past, 40 years or so. We still have a lot to make up for. The next thing we can look at is gross national debt as a percentage of GDP. If we look at where we are, if this was a business, the business would be bankrupt. If this was a personal budget, you would be bankrupt. If this was anything other than the United States government, because we are the standard, we're the world standard, the US dollar, then the country would be bankrupt, right? So when we look at this, we have to think to ourselves, we are significantly off trend line. Our average was around 35%, so we're effectively 3x our average since what we started in 2008. It wasn't just COVID, right? It was the 2008 correction where we started this, and we are now 3x off of our historical average. So the question you have to ask yourself is, what does this mean? What does everything mean? I was at a real estate conference with the Norris Group, with Bruce Norris. If you're in real estate in Southern California, I'm sure you've heard of him. But a discussion there is, as well as with a few other investors, there's basically two options that this country is going to take. One is the Fed's fiscal policy is going to allow this country to go through a significant amount of economic pain. So what that means is we need to get back to baseline for these numbers. That would mean we keep interest rates not high, right? Right now, they're not high. They're just high relative to what they were 2 years ago. But we keep interest rates at about the average, at about 4%, which is going to cause pain, and we don't turn on quantitative easing. So what you'll see there is probably a static growth across the board, because we have to re-baseline from all this crazy unwarranted asset appreciation that we've gone through for the last 14, 15 years. And Bruce Norris coined the term the lost decade. Okay, so that is option A. Option B is the Fed decides to turn back on QE, to reduce interest rates. So if that happens, because things are too painful, we're going to see this number go up, and we're going to see this number go up. Okay, the downside there is a potential catastrophic meltdown of the financial system, right? We have never been anywhere near this level of debt, so we don't know exactly what's going to happen. We saw some bank failures, something like 15 bank failures that started with Silicon Valley Bank. So there's a lot of catastrophic things that can happen with option B, right? So most investors I've talked to think it's going to be option A, right? A lost decade, which means with indices, you can probably expect something like this, right? This is probably our best case scenario, where you've got static asset values, static real estate values, and maybe even some decline there. So, and that was an answer to my friend's question of, hey, why take the risk of a fixed rate fund when the S&P averages 12%? Well, the answer is probably not going to average 12% for the next decade or so. The indices and anything with equity value, anything that is not producing dividends and cash flow is probably a bad place to be, right? So the last thing I want to do that I promised is compare a private real estate portfolio against the S&P in an inflationary environment, right? Because the last video I did, the S&P was going down. So I'm sure a lot of people are like, oh, of course you're going to do better than the S&P when it's going down. Let's talk about, I will compare it over a 4-year period, which was the highest equity gain from the S&P ever in the history of the S&P. This was during QE, this is during COVID, this was before the crash, right? So if there was any time when the S&P is going to do better than passive real estate, it would have been this time, right? So these are, and this is not going to be a detailed analysis here. So the first thing, let's take a look at the S&P in the middle here. So in January of 2018, it was about 2,700. And then January of 2022 is about 4,800. So over that period, you're looking about a 20% ROI, right? So the best the S&P has ever been. So one property during that same time, and this is kind of just happenstance. I just happened to buy, these properties at this time. I paid about $10,000 for it, $10,000 down. I know a lot of you are like, this is impossible. Is it a very small Midwest town in Tennessee? It was a passive deal. I've never been there, never seen it in person. In January of 2002, I pulled out almost 3x what I put down in cash. These are real numbers. During that time, it cash flowed around $2,400. So what that means, my cash ROI, remember this term DPI, distributions to paid in capital, was around 63%, right? Never going to happen. This doesn't happen, right? This is not, these are almost seem like fake numbers, but these are real numbers. Total ROI was about 70%. So what this means is I now not only have no money in this deal, right? I got 3 times my money back already in 4 years. Most like VC funds will try to 3x a portfolio in 10 years, right? The best, the cream of the crop, the absolute best venture capitalists in the world, the best funds they've ever had, will try to 3x a fund in 10 years. This 3x'd my money in 4 years, and I have a cash flowing asset, right? It's about $100 a month, and this will continue to go up, right, as rents go up. My equity value is not included here. So I still have equity in this that's untapped. And it's about $200 below market rents, just because the tenants have been in there for a while. That's not a big deal. Good tenants are hard to come by. So when someone moves out, this still hasn't caught up to the appreciation in rents. So this is just crazy, right? So way better than S&P. Property 2. So I purchased about 6 months after, 18,000 down. I refinanced both of these at the same time. So I pulled out about 12K here. It was about 4K in cash flow. So the total ROI of this one was about 23%, and it's currently cash flowing at $300 a month, right? So I know compared to this one, it doesn't look like that good, but this is ridiculous, right? I almost have all of my cash out of here in 4 years, and for doing nothing, I'm getting $300 a month, right? So in total is about 38% ROI. Again, this is not including the equity that's in there. If you remember that term, TVPI, total value to paid in capital. So if we use that, this would be a way higher ROI, right? If I was estimating how much equity is in those houses that I haven't refinanced yet, the ROI would be much bigger. And I'm not doing that. So, but I want you to take away 2 things from this. The first one is that real estate not only has downside protection, right? You saw that in the last video. When the S&P goes down, of course, something fixed rate fund is going to be better, right? Because you're actually making money from that. But it also benefits from the same upside as the S&P, right? That's how I was able to take this cash out, where when the S&P is doing stuff like this because of QE in low rates, guess what? Real estate is going to do the same thing. So you benefit from that same upside. Just make sure you refinance once you're able to, so that you actually get those distributions out. The other thing, okay, the crazy thing, guys, I'm not saying I'm a good real estate investor. I'm not. I spend almost no time. I spent 10 minutes looking at these, but it's just because I trusted the operator, right? I found a great operator who I worked with, and he's the same guy I'm working with now. I found a good operator, and I just bought these. I just sold out of some. I sold stocks here. The guy was like, "Hey, this is a good deal. You should do it." I said, "Okay." That's it, right? So this is not time intensive. This is not stuff I'm doing myself. These are deals that are out there if you get connected with the right people. The last thing I'll show, this might be a little much. This was a correlation analysis I did, so not super related, but I just wanted to show you the orange line here was a hypothetical situation. If I got a 6% loan in addition to my cash and put that into the S&P, that was just to try to level the playing field a little bit, because with houses, they're typically levered, right? And the green is the total ROI of that second property I showed you. The aquamarine or whatever is the equity. So you can see there, guys, that in an upside market, in an inflationary market, that real estate is going to follow the S&P upside, right? So this was just a visual representation of what I've been showing you here. So in short, guys, real estate's a good place to be, right? I think, obviously do your own research, and make your own market hypothesis of what you think is going to happen here. But the key takeaway from this is that passive real estate, right? You don't have to do anything. You're not going to the properties. You're not, doing the management yourself. You're not doing anything crazy. It's just finding great operators. Is that passive real estate wins in up markets and down markets. So if you have any questions or you want to dig into the numbers any further, let me know. Stopping to share here. I hope that was helpful. And again, I just want to circle back. It's not like a bragging thing or anything like that. In case you didn't see the last 4 videos, my biggest pain point in this space is the lack of transparency. Is if you're going to go out and try to invest in a fund or a VC fund, or you're talking to private equity guys, or you're going to, thinking about a real estate deal, what I have found is that nobody provides the actuals, right? All they provide you is their projections, which I don't like. And nobody benchmarks against other opportunities, right? So that's what I wanted to do for you here. So you can see some real numbers for this. This is real stuff. These are real deals that happened that are available to you. So I hope you found some value. And if you have any questions, let me know.